The first function of accounting is measurement. We need to measure and record a company's business transactions. For financial accounting specifically, we are interested in measuring information that would be of interest to our external users. We want to record all the relevant business transactions that go on in a company from day to day and could be useful to a user of financial accounting information. Let's assume we work for a clothing company. Over the course of 1 month, we have a lot that goes on in the business. We make sales to customers. We buy clothes to sell to customers. We pay the light bill on our store. We pay rent on our store. We pay our employees. All of these are business transactions. All of these transactions are of interest to external users. We need to measure and record these transactions in our accounting system. Think of the questions recording these transactions can answer. How much were sales this month? Did we make money or lose money on sale of our clothes? How many clothing items do we have in the store? How much did it cost me to operate the business? Is the business healthy, and does it look like it will do well in the future? Once we've recorded the business transactions, we can communicate these results to our users in a variety of ways. But we're getting ahead of ourselves a little bit. Before we start preparing reports, let's get a little more organized. A company can record a lot of transactions in a short period of time. One way to keep organized and to have useful information is to sort the data into categories. Think about the clothing store. If you walked in and all the clothes were mixed up and in no apparent order, it would be hard to shop and find what you want. If, instead, the clothes were organized by type, dress clothes, casual wear, swimwear, outerwear, and then by size, you can easily find what you want. The same is true for accounting information. The categories we use to sort accounting data are assets, liabilities, and equity. Assets are the things a business owns. In our clothing store example, what would be categorized as an asset? What does the company own? They own the clothes that they want to sell, don't they? In accounting terms, we call this inventory. Think of other things a business could own: a building, a car, money, investments, equipment. These are just a few, but I think you're beginning to get the picture. Liabilities are the things a business owes. In our clothing store example, maybe we ordered more clothing items, but haven't paid for them yet. We owe that supplier money for that inventory. The amount we owe them would be a liability. If the company took out a loan with the bank, that would be a liability. Anything we owe to someone else is a liability. Equity deals with ownership and profits of the company. This category isn't as simple and straightforward as the other two categories. It wanted to be special. There are actually 4 subcategories within equity: owner investments, owner distributions, revenues, and expenses. Owner investments are when an owner or owners of a company invest funds in the company. Owner distributions occur when the company has been doing well and wants to give the owners some of the profits. This is not a return of the owner's investment or a repayment of a loan. It's more like a bonus to the owner. Revenues are what a company earns in exchange for providing a service or good. Our clothing store has revenue every time we make a sale. Expenses are the costs of operating a business. What cost did our clothing store have in order to run the business? They had to pay the light bill, and pay rent, and pay the employees. These are all expenses of the business. Now, Just like we sorted and organized the clothing store, we can sort and organize our accounting information.